Welcome to this explainer. I want you to imagine we're sitting across from each other right now in a private, one-on-one executive coaching session. You're a seasoned professional, right? You've spent decades in the trenches, but lately, maybe a quiet anxiety has been creeping in. You feel like you've fallen behind on wealth building. You look at your younger colleagues and think, well, my window has closed. Today, we're going to completely dismantle that belief. We are going to treat your personal wealth exactly like a corporate turnaround. Welcome to the Executive Pivot. Let me introduce you to Robert. He sat in my mentor's chair at age 54, and he was feeling absolutely defeated. He actually said to me, I think I missed my window. I spent my 30s raising children, my 40s paying for their education. I have $67,000 saved, and my retirement is just 11 years away. You see, Robert felt like he'd already written the ending to his financial story. He bought into that devastating lie society sells us, that building wealth is exclusively a young person's game. He really believed that because he prioritized his family, his best compounding years were just gone forever. But here is the reality check, and this is the paradigm-shifting rebuttal for our entire session today. You have not missed anything. You've simply been playing the wrong game. The financial industry absolutely loves the lie that you're out of time, mostly because it keeps you passive. But listen, building wealth after 50 isn't about starting over from scratch. It's about stepping onto a completely different playing field. It's a game you are finally perfectly equipped to win. All right, phase one, the executive intervention and leveraging the late start advantage. Let's completely reframe your age and those decades of experience, because far from being a liability, your history is actually the ultimate boardroom leverage. Think about a 25-year-old novice compared to a veteran like you. Sure, a 25-year-old might have raw time on their hands, but their market judgment, it's built purely on theory. When a problem arises, they just see the symptoms. But you, at 50 or beyond, you see the actual answer. Your judgment is built on error, observation, and real hard time. You already know which business ideas consume your life, which relationships drain your wealth, and exactly what a bad deal looks like from a mile away. You've survived the expensive mistakes and paid the tuition on them. And when it comes to investing, that kind of judgment is vastly more valuable than raw capital. That incredible judgment allows you to enter what we call the compression window. If you take an investment of $1,500 a month at a 9% return, the most explosive growth doesn't happen at the beginning. It happens at the very end of the building period. Between year 10 and year 15, the jump is just massive, catapulting you right to $1 million. So the cost of waiting right now, it isn't linear, it's exponential. The decisions you make over the next 3 to 4 years pour the concrete foundation for what everything looks like at 65. You compress the growth specifically because you stopped making those unforced rookie errors. Moving into phase 2, restructuring your cost center, also known as the expense surgery. If you were brought in to save a business that was actively bleeding cash, your very first move wouldn't be to frantically scramble for new revenue, right? No, you'd stabilize the bleeding. You have to treat your personal finances with that exact same executive ruthlessness. So how exactly do we execute this expense surgery? Well, I had an executive client named David. He was stuck saving just $4,200 a year on a $96,000 salary. So we put him through a rigorous 3-step process. First, he audited 12 months of statements, hunting down every automatic decision his past self had made. And guess what? He found an incredible $1,840 a month in pure recurring waste. He eliminated all those lifestyle costs that produced absolutely zero value. By stabilizing that bleeding, his savings rocketed from $4,200 to $26,000 a year, and he didn't earn a single dime more to do it. He basically operated his way to wealth before earning his way there. But listen, all of that surgery is completely useless if you commit what I call the single expensive mistake. Imagine a disciplined professional investing $800 a month into a market returning 9%. Great, right? But on the flip side, that same person is carrying $30,000 in credit card debt at a brutal 24% interest rate. That is just controlled financial deterioration. Trying to invest while you're dragging around high interest debt is literally like faithfully carrying water every morning to fill a barrel that has a massive hole in the bottom. You absolutely must ruthlessly eliminate that high interest debt before focusing on investing. You've got to close the hole first. Phase 3, monetizing an irreplaceable expertise. Stop selling wholesale. Once the bleeding has stopped, we can finally move to the revenue generation phase. And as a seasoned executive, my direct advice to you is simple. Stop selling 30 years of deep, irreplaceable industry knowledge wholesale to a single employer just because it's convenient. Let's clearly define exactly what you possess. It's called the irreplaceable skill premium. The open market pays based on one main variable: how difficult you are to replace. If your job can be taught to someone in 2 weeks, you earn the cost of that 2-week training. But if your expertise took decades of complex pattern recognition to build, the market valuation for that is massive. Honestly, your current salary probably just reflects your employer's convenience, not the actual, true value of your irreplaceable knowledge. Let's bring Robert back into the picture and see how he applied this. At 54, he audited his 22 years of logistics expertise and supply chain problem solving. By 56, he didn't learn new skills, he just repackaged the ones he had. He started consulting independently for multiple clients, quickly replacing his old salary while actually working fewer hours. He then funneled all that freed up capital directly into his compression window. By age 65, he hit $1.1 million. He simply stopped underpricing what 2 decades of pattern recognition was actually worth. Now, as you scale that revenue up, your goal is to cross the income diversification line. Whether that looks like owning 3 dividend-paying index funds, maybe a single rental property, or building out one digital asset, the exact dollar amount isn't even the primary focus at first. The structure is what matters. You need to cross the line into structural income. That's money that scales while you sleep. Right now, your physical presence is a finite resource with a hard ceiling. Structural income breaks right through that ceiling. Phase 4. Protecting your decision zone, categorizing late-stage threats. So, you've built momentum, you're compressing time, but now we have to protect the asset. We need to identify the specific, quiet threats that can dismantle late-stage wealth building. Surprisingly, the greatest threat to your wealth is rarely market volatility. It's actually 4 personal disruptions: ignored health warnings, large emotional events like a divorce or sudden job loss, toxic social environments, and elaborate investment architectures. The decisions you make in the immediate aftermath of a personal crisis, what we call the protected decision zone, will often destroy more wealth than a market crash ever could. During periods of emotional turbulence, the golden rule is extremely simple: make no large, irreversible financial decisions. Period. Let's talk about the very first threat on that list: your health. $190,000. That was the staggering cost of a medical recovery for a builder named Thomas. He suffered a cardiac event at 65 after basically ignoring the warning signs for 20 years. He lost 2 full years of productivity and a massive chunk of his projected retirement savings. Listen, poor health is the single most expensive liability you can have on your balance sheet. Treating your health as a casual preference instead of a critical financial priority will absolutely dismantle everything you've worked so hard to build. And then there's the social environment audit. Take a guy like James. He hangs out with people who measure success by expensive vacations and visible consumption. It's this unconscious competition that completely inflates his lifestyle. But then you have Michael. Michael deliberately surrounded himself with quiet builders, like a retired engineer and sensible family investors. His conversations changed, his decisions changed, and his entire trajectory changed. Your social circle is rarely neutral. It's either quietly accelerating your progress, like Michael's, or it's unconsciously dismantling it, like James. We also have to audit complexity. Always remember the simplicity premium. The absolute simplest strategy that you will actually maintain for 20 years will always beat the highly optimal strategy that you abandon in 2. I had an executive named Martin come to me managing 9 different platforms and 5 separate strategies. He was spending 8 hours a month wrangling this tangled mess, and it actually performed worse than a single boring index fund. Financial complexity adds friction and stress, not returns. He consolidated down to 2 accounts in a single afternoon, his stress vanished, and his returns improved. The simplest strategy wins because you'll actually stick to it when things get rough. Let's slow our pacing down a bit here as we enter phase 5, the final scoreboard, defining your end game. We need to talk about what this whole aggressive corporate turnaround strategy is actually building toward. What's the point of it all? First off, it requires a written number. You cannot navigate toward a vague, fuzzy feeling of security or just having enough. Feelings are a constantly moving horizon. You need a highly specific destination on paper. Calculate the exact monthly income from your investments that would allow you to stop working without any fear. I want you to literally write it down tonight, because when your goal is finite and measurable, it can actually be achieved. Because when you finally hit that number, the ultimate realization hits you. Remember Robert from earlier in this explainer? When he hit his $1.1 million at age 65, he realized something profound. The money had done something he entirely didn't expect. It had given him time. Time that wasn't mortgaged to a job he needed to keep or a debt he needed to service. The $1 million wasn't the true product at all. The true product was time. The money is simply the ticket that buys back your time, allowing you to show up fully, operating from a position of real strength for the people you genuinely love. Which brings us to my final challenge to you as your coach. Will you use this time to build something that outlasts the final paycheck? You have the executive experience, you have the pattern recognition, and you have the late start advantage. So stop waiting for a sign, stop waiting for permission. The ending to your story is not written yet. Make your first definitive decision today and execute your pivot. Thanks for joining me on this explainer.